Let's talk about the basics of economics, and this is the first video along those lines. So let's get a picture of what the economy looks like, how we measure the economy, what does productivity mean, what are the different economic indicators, and so forth. The economy looks like this. This is a typical picture of what people draw when they're talking about it. This is a mixed economy. And you'll notice that as we go through here, changes in one flow are going to affect all the others. So for example, if the government raises taxes, households here are going to have less money to spend on stuff. A resource market down here is where businesses go to purchase raw stuff, which includes goods and services. So they lump people in here as well as minerals. Product markets sell finished goods over there, and it includes financial markets like banks and so forth. Okay, so let's go through this. We'll start here at your house, and you will supply labor and capital to the raw resource markets. So you're an input for raw resources, and as a result, you get income, wages, and interest. People pay you for doing that. Okay, so let's start back here. Raw resource market. There's inputs to the factory, and that could be your labor, it could be minerals, it could be wood, whatever. Goes into the factory, and as a result, costs, wages, materials get purchased. So money comes out of the factory to buy this stuff. Onto the factory, we have finished goods. So they take the stuff, they build finished goods, cars, shoes, watches, whatever, furniture. And as a result, people buy that stuff, and the money comes back here to the business. And then to close this out, these finished goods are purchased by households, and the money from households come back here to supply the money to make this operate. So this is how the economy works, and you can see it's all highly interrelated. If any one of these arrows goes away, something bad happens. And in the middle, we have the government, and the government, in exchange for tax dollars, does goods and services for us. They protect us, they supply things that we need, water, streets, and so forth. So how is a country's economy and productivity measured? Well, the productivity is the average output of work per hour. And that is not number of hours worked, that is how much a person can get done in 1 hour. So for example, computers have greatly increased our productivity. Things like gasoline cars versus horse-drawn buggies and things like that have increased our productivity. Increased productivity is directly tied to economic growth. So there are many measures, indicators of economic productivity. The most common that we hear about are GDP, and it used to be called GNP. It's the total value of all the final goods and services produced by all the people in the boundaries of a country in a one-year period. So in 1929, the US GDP maxed out at about $104 billion. That's adjusted for 2012 dollars. 1932, it was 59 billion, again adjusted. And in 2023, it was 27 trillion. So yeah, the worker productivity in the United States has been going up tremendously. Now, the gross world product is the sum of all countries' GDP. So that's everybody in the world doing this, every country adding them together. And in 2024, it was roughly 110 trillion. So the US is roughly 1/4 of the world's GDP. So a very significant player. So more economic indicators. Well, deflation is a general decrease in the prices. Yeah, so when prices start going down, you may say, well, that's a good thing. For consumers, it's a good thing for a little while, but it has some serious ramifications down the road. So the worst in U.S. history, the worst deflation in U.S. history, prices fell an average of about 7% a year from 1930 to 1933. If those dates sound familiar, yes, that is the Great Depression. Inflation is a general rise in the level of prices. So when the average of all prices of goods and services is rising, and that's across the United States. So the long-term average per year is about 3.4%. If it's more than 3.4%, well, people start complaining. If it's less than that, people may start complaining because it may mean that the economy is slowing down. So for example, a house that cost a certain number of dollars 20 years ago will likely cost more now, and it's going to cost quite a bit more in 20 years in the future. But it should go up in increments of 3.4% per year if the economy is running at an average pace. So let's look at an example of how inflation can impact our business. We need to calculate the cost of raw materials for our proposed production plant. We're going to build a plant. We're going to put in a certain number of raw materials a year and a certain amount, certain number of dollars. And we're going to do that for a certain number of years. And we got to see if this is going to pay off. So we're going to look at 10,000 tons a day input to our factory. The plant's going to be open in 3 years, and the plant's going to run for 15 years. The cost of raw materials today is $500 a ton. So that equals $5 million a day. And that's today's dollars. Inflation is 4.6, simple, so it's a little higher than usual. We estimate the raw material cost over the life of the plant. So today in year 0, $5 million a day, we begin construction. Next year, January 1st of the next year, $5 million is times 1.046. That's the inflation rate. So now it's going to be $5.23 million a day. We're still building our factory. In 2 years, we're at 5.23 million times 1.046. So now our daily cost of materials is going to be about 5.5 million a day. And in year 3, where we're finishing up the plant, it's going to be $5.7 million using the same type of arithmetic. And we finish, and now we open the plant. In 15 years, we're going to be spending $11 million a day when the plant closes. By the time the plant closes, we're going to be spending $11 million a day. So look what has happened to our costs. What happens if we did not calculate that up front? This is how a lot of people get in trouble. They'll either borrow money or they will not look at the costs of operations increasing with normal inflation over time. So if you omit inflation in your calculations for the plant, it's probably not going to be good. There are 2 types of inflation, and one of them is simply because prices increase because of strong consumer demand. People want more of something. For example, in summertime, people use more electricity for air conditioning, and as a result, to try to hold down the use of electricity, some places, some cities, some states will charge more. They'll put a surcharge on the electricity use to try to hold it down. New popular products, it could be a car, it could be the newest smartphone. The prices will be higher, and then they'll fade off over time as the demand dwindles. In wintertime, fuel use and demand increases. So yeah, your car burns more gas and you burn more home heating oil. So prices increase because the demand is higher than supply. So the demand goes up faster than the supply. Firms like airline industries and whatever are more sensitive to fuel cost increases when that happens. And maybe doctors, dentists, and people with more money may be less sensitive. So when prices increase, workers and labor overall may ask for more money. Yeah, they need to maintain their lifestyle, they need to eat, they need to buy that car. Increasing expenses will happen to businesses as the business has to pay their employees more. Their expense goes up, and then the business will charge more to cover the fact that their employees ask for more money. And yes, it's a spiral. Inflation is a spiral. And the second type of inflation is cost push inflation. And this is the fact that when companies get charged more by others, they move those costs on along to the end consumer. So when the price of steel goes up, car manufacturers are going to charge more for the price of the car. They can only absorb those price increases for a certain period of time before they have to push them along. And then when oil prices increase, airlines have to charge you more because the price of their fuel went up. Automobiles, consultants have to charge you more because their flights cost more. Cars cost more to operate, et cetera, et cetera. So we have the formula. If you haven't seen this video, profit equals revenue minus expense. You should watch this one. It's very important to know. When cost of firms increase, that's the E, that's the expense here. The profits fall because, when you have R minus E, the P is going to get smaller unless prices to consumers are increased. So that's the R. And consumers keep buying at the increased price. So yes, there's a lot of assumptions in there. When prices increase overall, on the average, that is inflation, and increasing prices lead to inflation. That's the way it is. When prices of things increase, workers may slow or stop purchasing. That lowers the R right here to firms, especially early in an inflationary period. So when prices are going up, yeah, this may lag, and it can hurt the workers the most, and they will stop buying, which causes the spiral the other direction. So economic indicators. Well, we've already talked about a few, but unemployment rate, and we'll talk about this a lot more later. Rate of change of unemployment, that's all it is the rate of change. It's how much per time that it's changing. So it's not a fixed number. It's not like 25 people lost their jobs. It's like 25 people per day are losing their jobs. So it's the number of unemployed people divided by the total number of people in the labor force times 100, and it's given a time period. So it's per month, per quarter, whatever. The consumer price index is another one of these economic indicators, and it's an index calculated monthly, measuring changes in price of a fixed basket of goods and services purchased by a typical consumer in an urban area. So yes, the people who do this, they have what they call a basket, and it's like if you went to the grocery store with a basket and you put in eggs and flour and cereal and coffee and whatever, and then you check the price of the stuff in that basket every month. Yes, that's exactly what they're doing, something like that. So it is a measure of inflation. The producer price index is the index that measures wholesale prices that producers receive for finished goods. So it's like the consumer price index, only it applies to producers, so commercial operations. So finished goods. It contains components of raw materials and partially finished goods. So a finished good is an airplane, a delivery truck, things that most of us don't buy. Partially finished are things on the assembly line that are not done yet. And raw goods, chemicals, fuels, wood, metal, that kind of stuff. It's like CPI, but as I said earlier, it's for companies, and it can help predict coming inflation or deflation. So economic growth is an increase in a nation's output of goods and services. The more a nation produces, the higher its standard of living. But pollution increases, so that increases the government's expenses. It requires more public facilities, so economic growth requires roads, electricity, water, hospitals, all that stuff, hence more government expense. So governments typically try to balance growth with general quality of life. You cannot go out and do all of these things at once, or you will trigger a huge inflationary period. So this is a repetition. GDP is the market value of all goods and services produced in a country. When GDP is increasing, an economy is growing. Important fact to remember. Typical annual GDP growth rates in the US are somewhere between 3% and 7%, and it changes from year to year, quarter to quarter, and it's a good way to measure economic growth. It's very common. You see it on news reports and so forth. But GDP has to be growing more than inflation. So when GDP growth equals zero, the economy is stagnant. That's a bad thing. A decline, negative GDP for 2 consecutive quarters is a recession. Yes, we hear that word a lot and it's thrown around, but there is an actual definition for it. GDP declines for greater than 2 consecutive quarters. Balance of trade, I've got another video on this, but it's the total value of a nation's exports minus the total value of its imports over a specific period, which is usually a year. So simply put, it's exports minus imports for the year. In a good economy, typically exports are greater than imports and balance of trade is positive. This is kind of fuzzy. It's not always true, but yeah. Consumer confidence index, how optimistic consumers are. That's you and I when we're at home. Are we thinking about buying a refrigerator, a new car, or are we a little concerned and we're not sure about our jobs, so we're holding back? Bank credit is not used so much anymore because of some oddities. It's a statistic measuring the lending activity of commercial banks, how much is being loaned, how much is being repaid. And corporate profits, well, the total amount of profits made by corporations in a given time period. This is a little bit sleazy because we have had periods in the late 2000s where actually profits were being made, although the economy was sinking, which is, Inflation rate, economic statistic tracking the increase in prices of goods and services over a period of time, typically calculated on a monthly or annual basis. So this is the inflation rate. High inflation destroys cash's value and overvalued property, and it overvalues property, I should say, and other types of capital. So yeah, if you have money in the bank and there's high inflation, the value of that money is going down because stuff is becoming more expensive. So the $30,000 you had in the bank to buy the car may not buy it, in 6 months after high inflation because the car is now $35,000, $36,000. So cash goes down in value, houses, cars, gold, etc. go up. And national income, the definition is total income earned by various segments of the population. It includes employees, self-employed individuals, corporations, and other types of income. So it's just basic income overall. Prime interest rates. This is the lowest interest rate that banks charge to their most credit-worthy customers. So this is their biggest customers, most reliable customers. They get these rates. As a consumer, you'll never see one. But yeah, it'll be very low compared to what we get. New housing starts. The total number of new home construction started during a specific time period. This has been very popular in the U.S., although again, we have seen some anomalies where this didn't hold up very well. So there are a lot of different indicators, and taken together, they can give you a good picture of the health of the economy. One at a time, they may not, but again, if you look at them across the board, yes, they can give you a good picture of the economy. So that's the end of part 1. On to part 2.